if you're looking to own property, if you're looking to be a real estate investor, there are some things that you absolutely need to unlearn when it comes to lending. Number one, getting the lowest interest rate will make it harder to pay off the loan early and to save money. Okay, that's number one. You want the right interest rate for you as a home buyer, or the right interest rate for you as a real estate investor to manage saving money and growing your equity. You need the right interest rate, not the lowest interest rate. Why do I say that? Okay, because banks have one product: they rent their money. And so if they're renting money and they want to make the most money they possibly can, why are they offering you ways to save money? Here's my question. If you're saving money, then the bank would have to be losing money, correct? Then why are they giving you so many ways to save money? Folks, if we take a look at the whole picture and start asking good questions, then why give me a lower interest rate when I would have been okay with the higher interest rate because I need their money? So that's one thing. Here's the other thing: refinancing. Okay. Refinancing to a lower interest rate may not be to your advantage. It could be, but it may not be, because we're focusing on the wrong thing. Here's another thing. If you're getting into your home or getting into as a real estate investor, here's something that'll probably blow your mind. Never, ever, ever, ever give a large down payment on a loan if you don't have to. Never do it. Never do it. So if you want to see an example of why you don't want to, I'm going to go over two examples today. One is down payments on a loan. Never do it. The other one is by lowering your interest rate, you are actually putting yourself at a disadvantage. Okay. So right now we have on the screen this $400,000 mortgage I was talking about. All right. So I've got a $400,000 mortgage at 4%. And so we're going to take a look at what we could do if the bank says, listen, if you put $100,000 down, you could make some headway on this loan. So let's take a look at that. So we're going to pull up another example. We're going to do a $300,000 loan because, listen, we're going to put $100,000 down on this thing. So at 4% for 30 years. Now, anytime the banks come to you with an offer like this, all the numbers are based on all 360 payments, 30 years. Everything they're offering is 30 years. So that what they're comparing is one 30-year loan against another 30-year loan. But did you realize that the average client with the P.I.L.L method pays off a loan in 7 to 9 years? So we're now looking at the interest cost for 30 years. You then have to look at the interest cost you would have if you were only in the loan for 7 years. Okay. And that makes a huge difference. But let's just take a look at these two 30-year loans. Okay. So we have the $400,000 mortgage, and the bank wants, $287,477.60 over 30 years. 287,000. That's 71% of what you borrowed. The bank wants in interest. But if I look at the $300,000 loan, let's calculate that. Now we're looking at $215,000 in interest over 30 years. So these are the numbers that they are contrasting: 287,000 versus 215,000. So if I just took a look at that, I might say, well, shoot, I'd be better off if I give them the $100,000. All right. So if we did a little bit of math here and we put in, I'm just going to round some things off, and we have 287. All right. And then we're going to subtract 215. subtract 215,000. Boom. That's $72,000 in interest saved over a 30-year period. Keep that in mind, because what we're doing is contrasting two 30-year loans. Okay. So if that's the case, I can save $72,000 in interest. If I give them the $100,000, then I might be tempted to do that. But let me show you what happens if we decided to take the $400,000 loan. Okay, the $400,000 loan. Now, if I have that, where is my $100,000, folks? My $100,000 is still in my bank. Now, we don't necessarily advocate doing it this way, but if all you know is putting down $100,000 as a down payment, then the only other thing you would know is to put it down as a prepayment. So if you still have your $100,000 in the bank and you are now getting ready to make your first payment on this $400,000 loan, could you now apply your $100,000 to this loan after you close, not before? Let's take a look at cumulative principal here. All right. So if you take a look at cumulative principal, you can tell where you are at any given time. So we're going to scroll down to $100,000. Okay. All right. $100,000. Look at this. Look at this. We're still scrolling. We're still scrolling. $100,000. That takes us down to, boom, line 138. So if we take 138 and divide that by 12, we just knocked 11 and a half years off this loan in 1 month by putting the $100,000 down as a prepayment instead of a down payment. And now, instead of saving $72,000 over a 30-year period, we've already saved in just 1 month $161,000 in interest we never have to pay the bank. And that's just in 1 month. We've already saved that money we never have to pay. Folks, there is a huge difference. I mean, a tremendous difference between putting your money down as a down payment and putting it down as a prepayment. Are we seeing that? Do you see that today? I'm telling you, folks, do not do it. Don't put your money down as a down payment if you can avoid it. Now, that is not to say, all right, and somebody, please don't misunderstand. You have to put a minimum down depending on what kind of loan you have. There's a minimum amount down that you have to put down, but don't put any more than you have to if you can avoid it. Use that money to develop your equity, to kill interest, and then to build equity much faster, much cheaper by using your down payment and a different way as a prepayment to the loan. All right. So listen, folks, this is something that I just love talking about. Now, these things apply to whether it's a home, it's a business, it's a church, it's a car, whatever you're doing. Let's make sure that we are unlearning what we've been taught over the last 88 years and learn how to save money overall in managing your loans. Don't look at just the payment. Don't look at just the interest rate, but you want to look at the interest cost of managing your loans. And let's drive the interest cost on these loans into the dirt by learning these techniques.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.